I guess, Kyle, we've made a point in the past. It's got to be great to just be able to stimulate forever. Throw a trillion here, a trillion there, 1.9 trillion here, 3 trillion there, and it would be great because it does help GDP. We're always worried about, the chickens coming home to roost. If we can sell our bonds and they're that attractive, do we delay the eventual arrival of the chickens coming home to roost so we can party like it's 1999 with the stimulus because we don't have to worry about rates going up? I think that's his point why it's tough to be bearish on stocks here.
That's right. I mean, look, I had breakfast with Kuroda a few years ago, and I said, you guys own more than 100% of GDP of your bonds at the BOJ, and yet you say you're not monetizing your deficit. And he gave me a big belly laugh, and he said, Kyle, we're only monetizing our deficit when the market tells us we're monetizing our deficit. And in the end, we're 10, 15 years behind Japan and their QE program, and so is Europe. And so we're all in this together, and these central banks are never going to turn and decide to be fiscally conservative again. I mean, Joe, when was the last time you heard the words Tea Party? Even under a Republican administration, we just forgot that we needed to be fiscally conservative. So now we have, I think we're going to have ever increasing deficits. And what politicians have learned is deficits don't matter. The Fed's going to be there for them. And the Fed has been engaging in extraordinary monetary policy for the last decade. So it's not going to change anytime soon. It's only going to get worse.
Well, anytime soon. Do I need to feel like I'm in the roaring 20s and we're closing in on 1929? I mean, when do you see, it gets bigger and bigger and bigger, what you're describing. And we become less and less concerned as we go along. Do you expect the eventual comeuppance to be much worse based on that? Or is there a way to spread it out so that we work it off over time with growth? It's hard to grow when you have that much debt, though.
The last time the U.S. was at this debt level as a percentage of GDP was after we deficit spent going into World War II. Right, in 1946, we had about 106% of GDP. But guess what? We won the war, and we reduced the productive capacity of 2 continents. And we ran a trade surplus with every single trading partner that we had on the back end of World War II. And we were able to pay that debt down over, call it the next 30 years, into a very low level. I actually don't think that's the case this time. Clearly, we're not engaged in a world war, and we're not running a trade surplus with almost anyone in the world. So, I actually think what the quote comeuppance here is going to be is further stretching of our call it social fabric in our country, right? That the rich are going to get much richer, again, in a nonlinear way. The middle class won't be able to reach up to the next house price because their incomes aren't moving as fast as asset prices. And the poor are just going to stay poor. So that gap, that wealth gap is going to continue to widen. And that with it is going to come more social unrest. The fact that President Biden's here now, everyone might be taking a breath and saying we're going to be back to unity. But this is a much deeper problem. The Fed can't have its cake and eat it too. Right. And I think social discord is discourse is going to happen.
Shepard Smith here. Thanks for watching CNBC on YouTube.